Good afternoon. I'd like to thank everyone for taking time out of your busy schedule to attend the webinar. My name is Scott Friede, and I am the Division Director for InsureBank. We are excited to present Shifting Economic Market Factors, What You Need to Know, which will explore new macroeconomic factors that are at play. Insurance agents and brokers are facing softening P&C pricing and a changing interest rate environment. With us today is Mark Kreitz to talk more about that. Mark joined Reagan Consulting in 2017, and he is a partner in the firm. Mark primarily works with clients on mergers and acquisitions, agency valuation, and strategic consulting. And with that said, Mark, I'll hand it over to you.
Thank you, Scott. Good to be with everyone today, and thank you for joining us. We appreciate the opportunity to these webinars, and thank you to Scott and his team at AssureBank for having us. So today, I did a webinar, and many of you may have participated in that back in May. This follow-up that was really focused on also similar themes around what's going on in the market, but today there have been some, and especially in Q2 and now in Q3 of 2025, some headwinds in the market that we wanted to chat through. And they are, it seems like in our industry, ever-changing dynamics in an interesting way. And a lot of that's been driven by consolidation. A lot of that's been driven by interest rate changes, as Scott mentioned, as well as lots of valuation changes across really the last decade plus. And so we wanted to walk through 4 market headwinds, and these aren't, please don't take this as us kind of presenting some doomsday scenario for the brokerage community, because that is certainly not the case. But there are things in the market that are happening, many of which that are totally out of our control as independently operating agents and brokers. But that being said, we should be aware of how other peer brokers, privately held firms around the country are responding and thinking through market dynamics that are existing today. And so, as Scott mentioned, Reagan Consulting, we're a boutique consulting and investment banking firm. We're headquartered in Atlanta, and then have an office in Washington, D.C. as well, but spend all of our time in this insurance distribution industry. And we're thankful for that. It is a great place to operate in, and we've done had several engagements over the years with the InsureBank team. So again, thankful for them to having me. We will reserve some time at the end for Q&A, as Scott mentioned. And so I'll be tracking along the way the Q&A and comments within the chat function on Zoom. And if I see one that pops up that's relevant to the topic that I'm addressing, I'll certainly try to pause and answer that. Otherwise, I'll leave some time at the end to address those questions. And so I hope everyone sees my screen. I'm going to dive in, and so I'm just going to four key headwinds that we're seeing in the market today. And number one, and this was something we couldn't say even 6 months ago. 6 months ago, we were just wrapping up Q1. We had just gotten through Liberation Day after the tariffs went into effect by President Trump, and the market kind of went into a weird place. The S&P had dropped. Brokers at that point in time were still witnessing really strong growth, public brokers included. And so as we think about the public broker community, there are the 5 well-established public brokers, which is Marsh, Gallagher, Aon, Willis, and Brown & Brown. Those are the firms that have been public for many, many years, decades in the making. And then there are other new entrants into that publicly traded hemisphere that exists today, and that is the Woodlands Group, Baldwin Risk Partners, now Baldwin Group, Ryan Specialty, the really only true wholesale MGA broker that is public, and then Goosehead, a franchise personal lines business. And so we have 9 publicly traded brokers that give us real-time market data, investor thoughts on what's happening out there. How are they perceiving our industry to be in the future? Investors in the publicly traded investors really are focused on what happens the next year, the next 24 months. How are these brokers positioned to continue to perform? And then basically price that into what they think the stock should be worth today. And in Q2, when brokers release their earnings every quarter, after the second quarter in July and August, when these earnings came out, from each firm, the market was shocked. And it was interesting because we in the industry, especially if you are big into commercial property or have exposure to various, property exposures, we kind of saw this coming. We saw, especially in commercial property, maybe other lines, workers' compensation has been soft for a while, but we saw really a softening happening, and we saw that in organic growth to some extent. But really, when we talk to our clients, we do a lot of evaluations, as Scott mentioned. And so early in the year, when we're having these evaluation calls with clients, we are getting real-time data. Like, yeah, it seems like our carrier partners are expecting some softening to happen in 2025, and that's really what took place. And so this page is a depiction and a summary of the publicly traded brokers. Goosehead is not on this. They have a different model, and so we've excluded them for this purpose. But this is the organic growth rates that we calculate at Reagan. We use public filings, other research that we do to try to dissect really what is the brokerage and risk management related revenues associated with each of these brokers. What would their organic growth was in 2024, the first 6 months of 2024, and the first 6 months of 2025. And it was a pretty stark difference in organic growth in just 12 months. 12 months ago, each of these firms were, two were double digits. The others outside of Willis and Aon were high single digits. Now in 2025, there was only one double-digit grower, which was Baldwin. And then you have the majority of the others kind of in the mid single digits, closer to 5 or 6%. And this change represented a 4% reduction in organic growth just for this group. And we think there's a few reasons for that because we didn't see it. And I'll show you some stats on the privately held brokers that we benchmark and survey, each year, every quarter. The public brokers were hit much harder. And we think that is for a few reasons. In particular, the public brokers have adopted what we call ASC 606, which some of you as privately held firms may have adopted. But it's a new accounting regulation that really went into effect a few, maybe 5, 6, 7, 8 years ago, where it basically accelerates the impact of revenues associated, in particular, with direct bill income with from your carriers that you receive directly, that they now present and record in their financials on an accrual basis. You still may, as a privately held broker, record your direct bill income on a cash basis. And so if it's a cash basis, you kind of get the exposure from a rate perspective when it comes in the door. The public brokers basically at renewal, they book this. If its premium was 100,000, now it's 90,000, it's booked. And that shows up immediately in their financials. And so that is a big piece of why we think the public brokers, and I'll show you again, the privately held broker community growth, which was not as drastically impacted by in Q2 in particular, but the public brokers were. And the second piece is we do think the public brokers, while geographically spread, all these guys may have international and national kind of potentially operations. They are exposed to maybe larger, fee-based, but also large commission-based management liability type and other professional lines exposure. And if you think about the lines that have been hit the most, it's professional liability, management liability, D&O, and property. I started with property, but a lot of these folks have a ton of professional liability exposure too. And so with those softening, plus the recognition of revenue more upfront rather than deferred or when cash is received, is really, we think, the couple drivers that are really impacting the public brokers. And what happened in the markets? How did the investors react when they posted these organic growth figures? We saw a pretty large decline in share price, which is how investors react, is they start to sell their shares, but they think it's overvalued. And so this chart represents, this is going all the way through October 10th. So 6 days ago, we took the share price all the way through October because we've seen this kind of continue as a trend and not a sell-off, but a pullback, if you will, in investor appetite for the broker community since those Q2 earnings releases came out in July and August. And so you have basically from the best performer, which has actually been Willis on a percentage basis, Gallagher, Aon are the only brokers that are in in positive territory in 2025. So from 1/1/25 to 10/10/25, there are three of the nine that have delivered positive returns from a share price perspective. The other six are negative, and you see Goosehead, Baldwin, Ryan, and the Woodlands Group have all been double digit down. Compared to the S&P, which has, yes, been propped up by the Magnificent Seven, the big tech-based companies that are really helping drive that, but other industries have also done well, has done 11.4% this year. And so this is, I think, the first year in a number of years when the public brokers have lagged the market. So we thought it was kind of notable. We talked about some of the reasons, but it really is the investors got really used to high single digit, even double digit, like 10 or 11% growth from these publicly traded brokers for the last few years. And this is the first year we've really seen that change, really since COVID. And public brokers have averaged down 2% this year. The S&P 11, so a 9% spread. That's a pretty massive spread. And when market cap falls, because the share prices come down, what happens? The valuations drop as well. This is a composite index of really the five long-established public brokers that I mentioned earlier: Willis, Brown & Brown, Marsh, Aon, and Gallagher. These are them benchmarked as a multiple of EBITDA, multiple of profit, going back to 2020. And you can see we have been in the 16s, 17s. We popped up to 19 times this year, actually. This year we are at 19 times after Q1. So at 331, the public broker community was valued at 19.3 times. In just 6 months, we are now down almost 3 turns in value, which is wild. And now the Q3 earnings have not been released yet, so we are still relying on Q2 data. So there's an asterisk here. But if you just take Q2 TTM performance and look at the market cap changes since Q2, it's been a pretty big retreat in terms of values. And this is, the caveat to this is still wildly above historical norms. The historical norms for the public brokers before the hard market, before really the investor appetite started to increase in our industry, which maybe 10 plus years ago, the public brokers have been valued at 12, 13, maybe 14 times historically on average. And so we are still in, very, very much healthy territory for public brokers. The reason this matters is if you think about the private equity community, if you think about the acquisitions that are happening every day, every week, in different parts of the country, there are still 50 plus active buyers, publicly traded and privately held brokers with private equity backing or not, that are actively trying to pursue acquisitions in the space. But when the public brokers fall, the private equity backed community, the private capital community does monitor the same thing we're monitoring. And this generally will have an impact on them as well if they're using publicly traded brokers and precedent transactions, other comparable firms and the transactions they've had historically. This has an impact. And so do we see valuations maybe monitor or come down a little bit? Maybe. We participate a lot in the M&A market, the Reagan team does, and so we have not seen any softening in values, especially for growing, well-established, even larger firms in particular, but even well-established, growing, specialized smaller brokers too. Still very, very strong values because the demand is still there. But something to keep an eye on. This is a headwind that we should be monitoring, especially as growth results and as you guys see press releases come out for public brokers in Q3. Keep an eye on how the organic growth headlines kind of come out, because we may still see some moderation and growth even throughout the year. So that's headwind number one. Number two, the public brokers organic growth story is certainly a headliner on that number one, which has led to some valuation reduction. But is there a slowdown looming for the privately held community? So the private broker organic growth, this is our survey, Reagan survey, that we do every quarter. These are year-end figures that we've tracked really since 2008. In 2015, this is the first year on this chart, but we've seen over the course of, especially after COVID in 2021, 22, 23, a massive tailwind from the hard market. Hard P&C market has rose dramatically. Brokers capitalized on that trend. And then we've seen really last year in 2024 some retreat, some lines starting to soften, in particular professional lines and property. And in Q2 of 2025, the latest available data that we have from our survey in Q2, we had a slight retreat to 7.8% in Q2 from 8.5% at the end of 2024. And in 2025, what happens full year? We don't know. Brokers are still projecting actually a 9% organic growth rate in 2025, which we at Reagan think is a little maybe on the aggressive end if we're at 7.8 through half of the year. But who knows? There could be a bunch of agencies that have not really been impacted yet by the softening market around professional and property lines. You may have other exposures, package, umbrella. You may have other exposures that really aren't impacting you quite yet. But our question is there some retreat on organic growth in full year 2025 when we get there? And really the story is the price changes. The CIAB, the Council of Insurance Agents and Brokers, the trade association in DC, that is really to the benefit of all the whole broker community and the industry. They report this on a quarterly basis, and we track their reporting. But they basically had in Q2 of this year the lowest positive growth that they've seen in I think 26 quarters. 3.7% was the increase, which is represented by the blue line, the dark blue line there, compared to 4.3% in Q1 and then 5.2% in the prior year, the same, Q2 of 2024. And so we're still seeing this retreat across all lines, but again, driven by property and professional. And then the Marsh has got their own pricing, and we track Marsh's as well. They reported even slower growth in pricing, but both reports, still show significant reductions over the past couple of years. We're not in a soft market right now. And so we get frustrated sometimes because we see these headlines that come out and say soft market is here. It's not a soft market yet. It is a softening market. But could we be inching towards a soft market? And as long as you've been able to renew your business year after year and you haven't been impacted, you've been able to deliver premium increases and secure the business while it's been painful for your team, for your staff, you've likely had to market more business more regularly. But if you've been able to capture and retain that business, you've had a windfall of revenues that have come in the door from commission perspective, which has been fantastic. From a performance perspective, very strong for profit. If we are not delivering new business results as we hope to, and this hard market continues to erode away at our growth, what happens after we can't deliver 7, 8, 9%? We deliver 3, 4, 5%. Our industry for a long time has been a 4 or 5% grower, and that's not a bad place to be. But relative to where we have been, this is a headwind that the broker community is really going to have to be thoughtful about in making sure your new business activities are really strong, making sure your retained business is strong as well. But a lot of that's just developing a great sales culture. So we can do a whole another session and webinar on the sales culture and how you define it, how you build it, and how you basically grow it. But we think the sales cultures that are really healthy, that are focused on new business, healthy retention techniques are really going to thrive, even in the midst of some softening market pressures. Headwind number 3. The technology disruption is accelerating, and we have done and tried to get a little bit smarter on how technology is going to continue to disrupt our industry. We think we are, who knows, a decade behind the banking financial institution industry and maybe other comparable spaces with respect to technology adoption. And technology firms 10 years ago, 7 years ago, when InsurTech kind of came into focus, their thought was, oh gosh, new buyers of insurance, millennials, Gen Z, they're gonna buy insurance through the web. They're just gonna go online and make sure they get the right price, check the box, and move on. And what a lot of those firms found is like, no, the relationship aspect, people like to talk and converse with people. And that fact alone was able to basically discourage a lot of firms from trying to displace the broker. And now that model has shifted, a lot into this embracing of the broker community, the traditional distribution model, with some exceptions, because we do think there is, as AI has come into focus, there's been a lot of things that privately held and publicly traded brokers have really kind of focused in on trying to make their firms more efficient, whether it's back office, whether it's producer focused, sales focused initiatives around technology, how to make your workforce more efficient, ultimately saving dollars in the long run. How do we do that? We're not disrupting the current network and distribution model, but we're enhancing it for sure. And so we've done a lot of surveying around this piece to try to see who's adopting artificial intelligence. Is this really there? Like, does this exist in the marketplace today? Are there firms that really can help? Because, I'm still a little blurry-eyed when I think about AI, where we're trying to get much smarter on it. We're not technology consultants, but we do know that there are a lot of our clients using AI forward-facing, maybe sales focused and back office focused. Direct bill reconciliations, that's been a big topic recently around how your agency management system can be enhanced through AI, especially around direct bill reconciliation, which is a disaster and a nightmare in general for any agency management system to do. A lot of firms are doing that. That's just an example. But there are other sales focused tools out there, and those are certainly tools that our team can talk about offline if that is of interest. But we look at we do an annual best practices study with the Big I. Many of you may participate in that study, but we are trying to understand what's really the adoption of AI this year in our study that was just completed in 2025 by revenue group. There are now 7 revenue groups in the best practices study. We've added an over $100 million category because we can learn as a privately held community. Like, we can learn a lot from the large brokers that have done this really well, not publicly traded, not private equity backed, but brokers that are still privately held. Are they adopting this? And this chart proves that almost all of them, especially over $100 million in revenue, are adopting AI today in different forms. But this, the middle group here, the $1.25 million to $25 million broker, about a quarter of the firms are adopting AI as we speak. And so we think these percentages, if we do this again 2 years from now, all rise. And we think the over 100 is probably at 100% at that point. And so this is coming. And the question is, and the good thing is, there are a lot of opportunities for privately held firms to just rent these AI tools. And so we actually think it may be a level setting opportunity for the privately held firm as you compete against the larger brokers. If you can go and rent that resource, rent something, and pay a subscription service that ultimately makes your firm more efficient, man, what a home run. It's going to cost something, but are you saving time on the back end for your people potentially? We did a survey with Broker Tech Ventures, a privately held broker kind of incubator, started by a couple firms in the space. We did a survey with them of their members, their broker members. All the kind of the investors into Broker Tech are all privately held firms. Are those firms really seeing impacts? Are they seeing really positive results from the investment that they're making in certain tools? And we surveyed this group, and we tried to define what a tech-enabled producer is. They're using, and I'll show you here, customer servicing tools, AI customer policy reviews, automated emails, outbound emails that go out at certain kind of check-in dates prior to renewal, for example, internal AI assistants using bots, web-based intake forms for policy applications, and then outreach software, CRM-like tools. So if a producer was using these types of resources, we would consider them a tech-enabled producer. And you can see this is a under 30, under age 35 is the dark blue bar. Over age 35 is the lighter blue bar. But these are median new business commissions that were written in a certain year. These are annual commission revenues that are written new business. The under 35 category, just earlier in their career, the tech-enabled producer was able to write over $170,000 in new business. For the non-tech enabled, just $104,000, which is still a great year. That's a great year. But man, that's a big delta. Same thing on the over age 35 category, 300 and almost $60,000 in new business versus 280,000. And so these are real dollars. We think this trend will continue, and you don't have to do all these things that we listed out here. These are examples of what other firms have adopted as an example, but we think these types of tools for your producers can be very powerful. And if it makes them more efficient, if it allows them to do 3 more appointments per week, add another account per month in new business, it can make a huge difference from the bottom line, and it may pay for itself as soon as these new business dollars come in the door. I just wanted to show you something we saw on a kind of an unrelated to the insurance distribution industry, but as we think about this AI evolution, there was an article written about kind of where are we? We had these chat GPT models that came out within the last couple of years. We are now in the autonomous agents, the bots that you see when you go to a website that use bots. It pops up, or you talk to somebody over the phone where they're using AI bots. That's happening right now. But what happens over the next 5+ years? This kind of subscription basically said it would be embedded in our daily life, professional and personal, in 2030. Wild to think about, but the acceleration of this is gonna be there, and so this is a headwind in the sense that if you're not thinking ahead about it, and if you're not focused, or at least talking to your peers about it, best practices forums, roundtable discussions, whatever it may be, we do think this is going to be a very, very important part of what happens next and who adopts. It's okay if you get it wrong the first time, but if you're just renting and you can kind of adjust and tweak and implement something new that comes out that's really helpful for your producer force, for your back office team, worth taking a look at for sure. Okay, last kind of headwind that I'll hit on today is kind of a it's kind of a 3-pronged headwind that wraps up into one, which is really interest rates, valuations, and these competitive dynamics are impacting internal perpetuation. And we know InsurBank is certainly active in the internal perpetuation M&A, but also helping fund internal perpetuation when that event comes. New owners are coming in, or owners are redeeming their shares. How to finance that? I know InsurBank has done that really well. But amongst all of that activity, there's a lot of market dynamics, economic forces at play that have made perpetuation slightly more challenging. And some of it's positive, but it does impact and have it does provide real concerns for our clients that are working through this right now. And so if you just look at the Wall Street Journal, the prime rate, this is not SOFR, the new LIBOR. This is really, we were trying to keep this simple and focus on really the Wall Street Journal prime rate, which is, I think, a good proxy for how a lot of privately held firms are thinking about what the current interest rate environment looks like. And so right now it sits at 7.25. And if you think about from 2000, right after the Great Recession, you can see this long line from roughly in the middle of the graph, 09 through roughly 2017, really 2019 and up into COVID. We had really, really low interest rates. Mortgages mortgage rates were really low as well. But you had this almost decade of what a lot of investors have called kind of the free money era. They could borrow funds for next to nothing, and that helped them acquire and acquire and acquire. And it also helped, especially prior to COVID, firms perpetuate. If you were trying to get loans for buying out older partners, those were much more efficient because you were not paying a lot in interest expense. But since 2022, we've had a crazy rise. The Fed, to curb inflation, obviously increased interest rates pretty dramatically. Now they just came down a quarter point, so the prime rate is now 7.25. It used to be, was 7.5, and it was over 8% back last year. And so now, I mean, while 7.25 is less than 8, it's still 7.25, and it's much higher. So when we're talking to a lot of buyers of equity, individual producers, upcoming shareholders, and a particular agency, they're looking around and like, I'm not going to make this work. This is brutal. Like, I got a mortgage, I got kids to pay for, I got other stuff. I'm not going to do it. I mean, those are real conversations we're having, and you may have them as well. And so I wanted to walk through, it's not just interest rates, but it's also values. And we talked about the public brokers, and they've retreated in real time because it is, they get real time feedback every day, every hour. There's a trade happening there. For the privately held brokers, of which this is what we call the Reagan Value Index. This is a composite of several brokers that we, Reagan, appraise on an annual basis. And we have benchmarked these firms since 1996. In 1996, the average revenue multiple for an internal valuation, this is not what you can sell your business for to a large publicly traded or private equity-backed broker. This is what you would trade for internally, employee to employee, shareholder to shareholder. It was 1.25 times revenue back in the 90s. And that really remained true in large part between 1.25 and maybe 1.4 times all the way up until roughly 2018, which is about the same time the performance of the insurance distribution community accelerated, in large part due to the hard market that we talked about. And now in 2024, this is last year's appraisals that we completed in 2025, the average multiple revenue for this group is 1.9 times revenue, internally traded multiple of revenue. That includes contingencies and profit sharing, et cetera. That's all in revenue. And the EBITDA side, well, how buyers price transactions, how investors think about publicly traded brokers and how they're valued. EBITDA, pre-tax cash flow, what really the owners of a business can take home. That's before you pay debt, interest payments, and taxes and all that stuff. But this is really what we call free cash flow. In 1996, this was 5.66 times EBITDA. That was the kind of going rate for an internal valuation. And that was in the sixes for a long time until roughly 2018. Goes into sevens, and then it's in the eights, and now it's 9.25 times. And so last page, we had interest rate rise. This page, value rise. And so if I'm a buyer of stock in a independently, privately held broker, this has gotten really expensive. Let me walk through an example. And so we did a private ownership study back in 2014. Reagan did. It's available on our website. Has a ton of information in it. But we developed this concept called the buyer coverage ratio. And the buyer coverage ratio is really, we tried to simplify it. It's distributions, your ownership dividends, distributions that you would pay out to your owners each year, divided by a buyer of stock, one of the shareholders that just came in or is buying more shares, their principal and interest payments on a note that they would take out either with the selling shareholder or with the agency or with someone like InsurBank. And when that was the case in 2012, 12 years ago, 13 years ago, the multiple of EBITDA for a valuation that we would do for an independent firm was 6.5 times. And let's just say the buyer of stock did a 10% down payment. They financed it over 8 years, interest rate of 4%. And then this firm distributes 80% of their EBITDA, of their profits each year. You have to retain some on the balance sheet, make sure you're protected for a rainy day. The buyer coverage ratio in that example in 2012, 100% is the goal of a distribution focused perpetuation plan. That was what we found in the study that we did in 2014 is the firms that had near or close to 100% buyer coverage ratio were effectively perpetuating to the next generation consistently. It's okay if the after tax, in this case, 62% after tax, meaning you still have to pay taxes on the profits that you are now, as an S corp or an LLC, taxes are passed through to you as the shareholder because you still have to pay taxes on the income, but pre-tax you covered the nut, and so it's still payments. Buying into a firm is still got to hurt a little bit, I guess, which is why the after tax at some firms are very generous and they cover all taxes. That's not the norm, but as long as our first year buyer coverage ratio is 100% and distributions grow from there, okay, it gets easier over time, and that's a fully functioning distribution model. The problem is in 2024, it's not 6.5 times anymore. It's now 9 times EBITDA. Same down payment, same financing term. Interest rate, though, is now 7.5%. Profits distributed 80%. The buyer coverage ratio first year is 63%. Tough. So that change, 100 to 63% just because of time. And two variables that changed, value and interest rate. And so what are firms doing to combat that right now? This is what we saw just a second ago, this left side, what we call the original 9 times value, 8 years financing, 7.5 interest rate, 80% of the profits distributed. But what if we want to maintain a distribution model? We want to make this attractive enough for producers, for leaders within the organization to want to buy stock in our business. If we've said, hey, the value is the value, what if we take the financing term up to 12 years? We keep the interest rate consistent, that's the interest rate, but we distribute 90% of the profits. Well, we've now closed the gap by 30 points to 93%. It's not perfect at 100, but that's okay. We are making this much more palatable for the buyer. And so all we've done here is just tweak those rates. And yes, I know I'm speaking on an InsureBank webinar, and they live in this world, and this is just examples that we've seen that would be helpful in these perpetuation scenarios. But I think the flexibility around how you finance this is really going to drive the interest level from the next generation that you feel like is ready and able and willing to try to come to the table and want to pony up for shares. It's really important to get equity in the hands of the next generation for a lot of reasons. For defensive reasons, golden handcuffs. For offensive reasons, equity ownership changes the way people think, the way people act, the way people operate and perform. And so that is really important. And so I just would mention this, the distribution-based, perpetuation has challenges for sure. And we've seen a lot of firms, we think, distributions, the way the private equity community would say is they're inefficient. You see on the screen, inefficient use of capital. They're a drain on the growth fuel of the firm. And they are a very, very hard to break habit for sure, because you're getting cash every year. Who doesn't want that? And so is it impossible? Absolutely not. Do you have to tweak a few things to make both sides happy? Probably in today's environment. And so a lot of people have transitioned to a stock grant program. We've installed a lot of those with our clients. It's a little bit more complex, and there's tax ramifications for that. But there is a different model that is more cash efficient. But also, if you want to just offer these kind of one-time, what a lot of clients do is they offer these patch bonuses, where, hey, if you're a first-time buyer, we'll handle your down payment. It's on us. We got it. Or something like that. That's just how do we make sure we get more in the door, because these competitive dynamics are real. And I just wanted to, as we think back to this private ownership study, there's really four pillars of perpetuation. You got to operate in a healthy state. You have to generate profits. You have to grow your revenue every year. You have to, if you're not growing, you're dying, kind of mentality. You have to have reasonable sellers, which means, hey, if the selling shareholder expects what a large publicly traded broker is going to pay for the business from an incoming shareholder, that's probably not a reasonable place to be. But there's a middle ground. There's an internal valuation that's certainly still high, gets them maybe the return they were hoping for, but it's still, you still need this next pillar, able buyers, people that are willing, able, and capable to stroke a check, to take that tax hit, to drive future performance, and ultimately be okay with that risk. And then you need an effective transfer mechanism. One being buy and distribute the profits, grants, patch bonuses, gifting, lots and lots of stock appreciation. Like there's lots and lots of ways to think through perpetuation. But these are the four, what we call in this study. I thought I'd mention it, these pillars, because as you get bigger, you will naturally have more owners in the business. In the best practices study, we basically, you benchmark the number of, and we didn't include the over 100 because the numbers start to get wild, but once you hit 25 million in revenue, that's a big category, 25 to 100, but the number of owners has to explode. Because if you have one owner for example, that expects to be perpetuated at some point, and you have 80% in one hand, the value is just too big, and they want their fair market value, which is great. It's just going to be too hard. And so ownership, the movement in ownership is going to be critical for, as you grow, making sure you're spreading ownership appropriately, not to just dilute yourself, but to make sure you've incentivized the right people, rewarded the right people, and protected those people as well. And I just wanted to show you from the best practices study as well, as you think about the weighted average shareholder age, for the smallest category, the average age for the shareholder group for under $1.25 million brokers is over 58 years old. Astonishingly, so it's like, okay, the average age is getting closer to retirement. Now, a lot of people work to their 70, 75, 80, and may not be an issue. But if you think about that versus the over $100 million category, which is under 47 years old, you see this transition over time as you grow your business. You have to make sure you transition responsibilities, succession of your leadership role, your duties, but in a large part, you have to make sure you get equity in the hands of the next generation. And it's interesting because the shareholders is wildly different, small firm to big firm. But when looking at the weighted average producer age, who's responsible for the production at each firm, it's almost identical. Barely a difference at all in terms of age. And so that tells us the able buyers may be there, because producers are generally the most active buyers in independent firms, just because compensation may be slightly larger as a result of them growing their book of business. But if the able buyers are there, they may not, maybe they're not able, if you're the owner of your firm, they're not be ready. They may not have the financial wherewithal yet. But our hope is with this statistic, okay, we're under 50 years old. We have some opportunity here, even at the low end of the market, to make sure we transition that equity. And I know this is a long one in terms of a headwind, but because of the interest rates, because of the values, this is what our clients are calling us every week for, in terms of how folks are perpetuating more effectively in today's environment. And so we wanted to look at the same Reagan Value Index that I've talked about, a number of firms that we appraise on an annual basis. And there were a couple different firm examples as we think about how much equity do we need to really get in the hands of our producers that are growing that don't really have any equity today, or maybe have a small slug of equity. And your firm may not be able to give equity, family owned, ESOP owned, bank owned, different ownership structures out there. We understand their limitations. And there are various models like deferred comp, long-term incentive plans, stock appreciation rights in order to reward the next generation appropriately. But in two different examples, producer A, let's just say their book size was, $1 million, $100,000. What just pick a number. It was kind of fixed in these two scenarios. $1 million we'll use. Producer A had a $250,000 value attached to his or her equity. And it could have been in the form of a couple different things: equity, deferred comp, LTIP, whatever it is. Producer B had a $1 million book and $1 million value attached to him or her. In this scenario, producer B is much more secure for obvious reasons. They have more value, and we're not saying that every producer needs to have 1 times their book in terms of value, but that is what the private equity community is starting to teach our industry, is like talent follows equity, and they're going to make sure their equity gets in the hands of their talented people. And so the competition is driving the producer B scenario. Producer A may be where the independent community is, and maybe we're a little bit behind in catching up and getting the equity in the hands of the right people. And so if you think about this producer equity multiple, it was 0.25 times for producer A. It's 1 times for producer B. Easy math. But we did some research on this we have a ton of data on this, on these group of firms. Producers with over $500,000 in revenue, which is for a lot of agencies where equity programs kind of kick into gear. Approximately half of those producers with over $500,000 books were owners. And we think that may not be enough. We do think that most producers get equity within the first 7 years, as long as they're successful in growing their book. If they're not successful and they're still invalidated and they're not, growing their book, yeah, it's not going to be everybody, but most producers that are growing their books of business are getting equity at firms around the country, independent firms within the first 7 years. But it varies widely, widely across firms. Again, different ownership models. But in this group, in the Reagan Value Index, these are firms that are regional, independent operating firms around the country. The median equity for the producers is 1.1 times their book of business. It's a good statistic, just to kind of as a takeaway for today, for maybe what could be the case for your firm down the road. And I'm going to just given time, I'm going to kind of skip to maybe this key questions, and then open it up for questions. But we walked through healthy operation, reasonable sellers, able buyers, and an effective transfer mechanism. As you think about leaving today, I know I hit you with a lot. Certainly some interesting things going on in the market. But as we bring it back to maybe perpetuation, where's your firm's greatest weakness of those 4 pillars? Is there one in particular that you really struggle with? And then are there changes that you need to make, whether it's to the way you've helped, tried to finance, purchase of shares by younger individuals, whether it's, hey man, we've been growing by the market, and I'm worried about really the softening exposure that I have in our market. And so, yeah, like our sales culture needs some work. Great. The hope today was to identify things as these headwinds kind of approach us, what needs to happen next at your firm. And I'll share this, Scott, with you, this presentation, but we have this checklist, and it is certainly nothing crazy, but it helps, people think about, are we checking a bunch of yeses here, or are we really struggling and having a bunch of no's? And this could be a 10-minute exercise to kind of like think through it. And then the no's, you really dive a little bit deeper in, and that's what you try to attack. but something your partners and you could think about work on. We're here to help. InsureBank's here to help as you guys think about perpetuation. But there are some headwinds heading our way, and we do think, um, whether it's public broker valuations that may bleed into valuations in the private markets, don't know yet. As long as demand is there and there's enough buyers that are active, there may be no issues and no real concerns from a value perspective. We just don't know. The interest rate environment is certainly not declining at a rapid pace, and so that'll persist potentially for a little bit. Um, and then we have these perpetuation issues. We have organic growth pressures that are happening right now, and so the market overall is changing, and we do think over the next 2, 3, 4 years, there's going to be a real separation amongst those that are really doubling down on growth, investing in technology, building a sales culture, distributing equity more widely. We think there's probably going to be a separation of those firms in a positive way versus those that are maybe not being as active in investing and getting equity in the hands of their key contributors. So I'll pause there, uh, Scott, and certainly can open it up for questions. But I know we got a few minutes left.
Yep. Okay.
Yeah, seeing maybe one question on on my end is there like are these large firms really, and this is actually a topic that I addressed in May, is are these large firms um, really impacting the privately held brokers, or is it really an opportunity for us to continue to perform? And so separate topic to maybe what we talked about today, but we do think all this M&A, if you think about like what's happened in the market, Gallagher, buying large firms, Assured Partners, um, NFP and Aon coming together a year and a half ago, McGriffin, Marsh. You have a lot of Brown and Brown strategies. You have 4 big mega deals that happened over the last really 18 months. And all those firms are probably feeling a lot of these exposures from an organic growth perspective based on the softening market, even more so. And so we're seeing a lot of brokers. This acquisition activity is actually opening a lot of opportunity for the privately held firms because in a lot of ways, these large transactions kind of orphan some small accounts that are bread and butter for independents. And man, that's a great opportunity. And so I think I answered that overarching question that I saw. But let me just end this. I want to make sure I didn't miss any on the webinar. Okay. Scott, I think that may be it.
I think that's it. Well, appreciate your time, Mark. A lot of insightful information there. Thank you, everyone, for attending the webinar today. Please reach out to Mark or myself with any questions.
Thank you.
Great. Thank you.